Hello everyone, Kieran King here, and welcome to this short crash course on the corporate funding journey. I actually did a full hour-long webinar on this a few months ago. Thank you, Angel Business Club, for hosting me, but I wanted to condense what I spoke about into a 5-minute summary for you all. If you have worked in or learning about the world of corporate finance, or even if you are an entrepreneur starting a business, you may have come across terms like seed, angel investors, Series A, B, C, D, so on, IPOs, private equity, venture capital. And what I'm going to do here is break down some of these concepts and slot them into a timeline of events or funding stages that companies could potentially go through. It's important to know that this is by no means the gold standard or by the book way for companies to grow. It is just a very simple outline of the steps that I see businesses take within my professional career. So let's grab a cup of tea and let's get to it. I'm going to draw two axes with time at the bottom, and I'm going to call it revenue on the vertical axis. So what is revenue? Very quickly, it is the top line essentially of money that goes through a company, not to be confused with profit. Okay. Anyways, I'm going to now split up this time axis into several sections. So let's say you start a business here on the left. In order to get this startup going, you will most likely need to pay people to make it, as well as various startup and setup costs. So how does one fund this initial step? Usually through friends, family, your savings, bootstrapping, grants. You might enter a competition, and so on. Okay, so this, and you may also find an angel investor, which is someone that will invest money into your project to kickstart it, usually for a percentage of ownership within said company. And at this stage, typically the amount invested will be anywhere from £1,000 to £100,000, for instance. For most people, you do not make profit at this stage. This is like the startup wobble, and I'm going to draw a red squiggly line here representing a company's revenue. You then enter into section 2 after your business matures or proves itself in a way, and I'm going to call this section seed capital. This is mainly financed through similar ways as before, but mainly, perhaps more, by angel investors. This is the stage that some companies also go through crowdfunding. Typically, you are looking to raise between £500,000 to £5 million here, and although you may be increasing your revenues during this stage, you may not necessarily be turning a profit, although it would be nice if you could turn a profit. The point at which you do turn a profit, this is essentially the break-even point. Section 3, I'm going to call this early stage, and I'm going to label it Series A and Series B. Which just essentially means different rounds of funding. Typically, your business will be making a bit more money at this stage, and this is where venture capital institutions and venture capital funds may invest. These houses will invest in order to achieve roughly 4 to 5 times their money within the next 5 to 10 years. At a slightly later stage than venture capital, you have something called private equity, or PE. Again, looking to invest a bit more for similar types of returns. Within this section, the funding figure is anywhere from £5 to £20 million. Now, as a business matures and becomes less risky, investors won't just be investing through equity, but also perhaps through debt or through a mixture of the two. And for more info on this, you can see my other video on the financial services sector. Anyways, in section 4, I'm going to call this stage the late stage, and I'm going to split it into Series C and Series D. Again, further funding rounds. The amount of money raised here could be anywhere from 20 million to 50 million plus. Again, I say that this is a very simplified overview and is based on what I've personally witnessed. It is by no means set in stone. So some of you may be asking at this point, but when does an IPO or an initial public offering happen? So what is an IPO first? An IPO is when a company first issues new shares to the public on a public stock exchange. It can be a way for businesses to raise a great deal of cash from the public to finance their business development needs. I've seen many people put IPO at the end after this on this chart after Series D. But in actual fact, an IPO can happen anytime during this whole journey. However, it is likely to occur either in the early or late stages of funding. So I'm going to draw an arrow here. But you also have follow-on offerings where new shares can be issued to the public after an IPO as well. Now, I can't stress enough that there is no by-the-book method, and this is simply a very flexible overview of what I have come across in my career. In reality, this is a complete mess with each of these stages happening at different times, and also people often use terms like the above interchangeably, so it can get confusing. Now, before I finish, I just want to say that there are a lot of alternative funding mechanisms out there for companies wanting to raise cash. For example, through R&D tax relief, factor invoicing, grants, and so on. But I'm going to leave that for another video. Please feel free to comment below, and if you enjoyed the content, please subscribe to my channel to be notified every time I do a new video. Stay safe and see you next time.